So, Will, tell me a little bit, because the home buying season in a lot of professionals' eyes, it may start to dwindle down a little bit. So as we're starting to head into the fall season and pretty soon the winter season, like what would you say are some of the common mistakes that home buyers make when they actually find the property that they really want to purchase?
No, yeah, good question. But I could say there's a handful of them, but I will say the main one, the most important. This is the main mistake that's made is buyers go out and just look for a place, particularly buyers that will need a loan, and they're not getting pre-approved first. So they might get to a home that they absolutely love, and they're looking at, let's just keep it number simple, $1 million home. Like, yeah, let's do it. Let's make it happen. They have no idea what their debt to income is and everything. They feel like they make pretty good money. They just don't know. But maybe they don't approve. They only approve for, say, a $750,000 home. And then they're dealing with that disappointment and stuff. Or on the other side, they probably approve for a $2 million home, a 1.5, 1.7. So you have to get pre-approved first. That's why you get with a realtor like myself, loan officer like Michael here, and get pre-approved, get your home buying plan in order, so you're not just out there just running around like a chicken with his head cut off and getting excited for possibly for no reason. That's the main and important reason right there, I would say.
Yeah, that's very true. Definitely don't. I've seen a lot of people sometimes go out there not prepared, don't go out there with a plan. They find the house,
Mm-hmm.
and then heartbreak sets in because they're like, "Why can't I get the house?" And it's like it's not as. I mean, it is simple, but it's not as simple as one may think. You know what I mean? Like, there's still a few moving parts that's required in order to get qualified and strategically be in the best position
Mm-hmm.
to win the offer when you submit your offer.
And to add to that, even when my wife and I, when we were getting our first home, we knew what we were approved for, right? So let's just say, I don't know, it was years ago. Let's just say you were approved for a $500,000 home. Boom, we have $500,000, right? So we're thinking of the 500,000 when our agent at the time, I don't know if they watch it, but they should have prepared us, right? Because once we've seen that we can get a home for $500,000, okay, the home we're in now has an HOA. We can't afford that, right? So if you have like a $300, $400, $500 a month HOA and a $500,000, we're thinking we can use all of that, but we didn't really understand the breakdown of the monthly mortgage payment along with all of our other bills. So I mean, I know there are a lot of agents out there that work close with their lenders and stuff, and we definitely, that's the main thing we do. That's why we attract a lot of the clients that we get. It's because we definitely hold your hand throughout the whole process and make sure you understand completely, for everything. So you can, when you have understanding and knowledge, then your confidence comes in.
And the main thing that like we want to prepare our home buyers with is understanding like what your purchasing power is, what your monthly payment will be, which will reflect like your principal, interest, your taxes, also projected insurance, and then also what your cash to close will be. Those are really the main like important figures that folks want to know is what is my monthly payment going to be and how much cash do I need to come out of pocket to purchase this house.
That's important though, but what you say, because we do that, is the cash to close. And what I see a lot of even realtors and lenders, if someone wants like a program, well, I can get in with 3.5% down. Yeah, you got 3.5% down, and they don't offer any other information as far. That's why I use go, hey, no, we'll say 6 to 7%. Automatically, oh, I thought it was 3.5. But once you break it down, you're already prepping them for it, preparing them. Oh, well, this is for closing costs. So then they're more happy. A lot of times they don't even have to use the whole 6.5% if they're trying to come in as low as possible.
So why would a seller? Because I get this question a lot. Because I typically when I am working with a realtor, working with Will, and we're working with a home buyer, and they're like, man, like I like everything. I got the cash and all this other stuff, but that monthly payment, man, like, is there anything you can do to help me with that monthly payment? And so this is where this conversation comes up, is because the strategy that I bring to the table is a buy down strategy, a 2-1 buy down strategy. And typically we need to ask the seller for a seller credit to pay for that buy down strategy. So I get this question a lot from buyers. They're like why would a seller even be willing to do that?
A seller wants to sell their house just as bad as you want to buy the house, right? But my job as a buyer's agent is to get you the home for the best price for you. That could be for the lowest. This is the best deal for you. And then the listing agent, as a listing agent, they're trying to sell the house for as much as they can too. But it also depends on the situation, the tailored situation of that client.
Every person's situation is very unique, and depending on what your situation is going to determine how we pull and tug on the levers that's available to us.
Mm-hmm.
You know, because like with the 2-1, like a strategy that Will and I have even done and discussed at times is, let's just say we're looking to help someone buy a house for like $800,000, right? And we need $15,000 in seller credits. Well, one way to do it is to say, hey, we're going to buy the house for $800,000, and here's the situation: we need $15,000, in order to help my buyer get a better rate and afford the monthly payment. Because everyone knows that affordability is one of the main barriers to get into a home in today's market. Is affordability. And so, not that we're throwing a pity party or anything like that, but a seller understands kind of the challenges that are out there for new home buyers. And so we can try to pull on that emotional lever to, hey, like, can you give us some sympathy love, essentially, to give us that credit to help our buyer have a more affordable monthly payment. If that doesn't work, then we can go to another option, which is, okay, we're trying to buy this property for $800,000 and we need $15,000 in seller credit. Instead, we can just increase the purchase price by $15,000, right? And then we increase the purchase price by $15,000, and then that will give us the cash that we need for the seller to give us the credit back, right? Now, I've heard kickback about this, and sometimes where, well, okay, that would work theoretically, but the sellers I've come across have said, well, what this is going to do is this is going to create a higher tax basis for me, right? And so if I increase the purchase price by $15,000, I'm going to have to pay, larger on the capital gains. Okay, true. And then also for the buyer, they're going to pay a higher price to purchase it as well. And so their property taxes is going to be a little bit more higher if they just stay. It really comes down to that person's situation.
Down to the situation,
because everyone's situation. Some people are willing to, hey, okay, I'm willing to pay extra taxes in order to get this home sold because I have another life event that's waiting for me that can't wait any longer. So sometimes you have to pay for the convenience to get things done immediately. But for some other people who's like, I got the cash, I got everything I need, I don't need that. That sounds asinine. Well, it's just not for you.
It's not. Yeah, it's not. And then we're not just creating these offers and throwing them out there. So part of what my job is as a realtor, as an agent, buyer's agent or listing agent, is to stay in communication even with the other agent. Say, hey, of course we want to get an offer in there, right? So they can either counter it. So that shows that we're serious. But I told them when we talked, like, doing this though, hey, this house is if it doesn't pass appraisal, are you okay? Just know what can happen. You're gonna have to come up with a little bit more. If it doesn't appraise, we're totally fine with that.
Right.
See, that's why communication is key.
Problems and solutions, and the main problem in housing today is affordability. Right? It's affordability, and people just can't afford either. People can barely afford, rent and all this other stuff now, and the cost of living now. but it's even harder to even get into your foot into that door, into your first home. You know what I mean? So like this is the solutions that, or excuse me, the problems that we solve is solving and trying to create solutions to solve the affordability, you know what I'm saying,
So
issue.
what are the like main differences between like FHA, conventional, and VA loans?
So
Okay.
like for conventional mortgages for first-time home buyers within conforming limits, okay, the minimum down payment is going to be 3%. Right, so we were just talking about we demystify myths
Right.
all the time,
Right.
and
Right. Right.
there's
Right.
people still thinking that you need 20%,
20%.
and you only need 3% for your minimum down payment to get into the home. Okay,
Wow.
that's just the down payment, and of course you also need your closing costs and
How
all
much
that stuff.
money did that just save them?
A lot of money.
And who's that? Just think about this, not to cut you off.
Sure, no.
Those who are saving or waiting for 20%, and not necessarily like, because that's what they were told. That's what they know. 20%.
Mm-hmm.
They've been ready probably for a couple of years.
I know.
To move in.
I know. And I mean, like, now there's some things, and again, you want to deal with someone who thinks with you strategically about this, you know, because there's always like a pro and a con. And you just have to make sure it works for you in your particular situation, right?
Mm-hmm.
Because the con, you know, to putting less than 20% for conventional mortgage is, okay, well, now you have a larger monthly payment.
For sure.
Right? Because you have a bigger mortgage. And then when you're putting less than 20% down, you have to consider the mortgage insurance as well.
Mm-hmm.
Right? And then there's other creative ways where we can eliminate that, but I won't get into that here. But with the less than 20%, it's the larger monthly payment. And the mortgage insurance is something to consider. Now, yeah, it's less cash out of pocket, so you don't need as much cash to get into the property, but that's just kind of the trade-off, you know. For FHA, FHA guidelines are a little bit more flexible. It's a really great option for first-time home buyers to get them into their first home. And minimum down payment for FHA is 3.5% of the purchase price. All right. Now,
so you said wait for the conventional was what?
3.
Mm-hmm. Okay.
Yeah, and I have to look up and I'll drop it in a link somewhere, but conforming loan limits. So each county in America has a loan limit. And so as long as it's within that conforming loan limit, then the minimum down payment is at 3%. Okay. Now, since we live in the Bay Area and we live in what's considered a high cost area, then our loan limits are a little bit more higher. So we can get away with putting a small down payment in order to get into a home. Once it goes outside of the conforming limit, then we get into what's called a high balance conforming limit, and which is just suited for high cost areas like the Bay Area, LA, places like that. And so once it gets into that realm, then the minimum down payment becomes 5%. Now, again, this is getting a little bit into the weeds.
So you saying conventional was less than FHA?
Correct. Yeah.
Okay.
Yeah. Now with FHA is very beneficial for first-time home buyers because the guidelines are very flexible. And what I mean by the guidelines being flexible, it's the debt to income that they're very flexible with. All right. Okay. And because the debt to income ratio, that's what determines how much loan the bank is going to give you. Right. Mm-hmm. So pretty much the bank in most cases are going to say that they're willing to give you, they'll lend 50% of whatever your gross income is. So if you make $6,000 a month, then they're saying that they're willing to afford you a $3,000 monthly debt obligation, including all of your bills plus your mortgage payment. Right. So with FHA, they're a little bit more flexible in that regard, to where they'll go up to 55%. And then the credit scores are a little less as well. And then for VA is a really great option for veterans. Because they offer 100% financing, right? And so 100% financing. Now you still need to figure out the closing cost, So closing costs still need to be figured out, So I sometimes I come across veterans and they're like, "Man, like I thought it was 100% financing." Well, it is. We're guaranteeing the whole first loan, that the first lien position, but there's still closing cost. right? And so there's cases where the realtor can, potentially negotiate, just kind of like we went over, maybe increase the price or maybe just kind of tug on the heartstrings a little bit to get them to cover our closing costs. And that can create 100% no money out of pocket scenario.
So it's like the criteria, whatever different, still speaking on the VA loans, for your debt to income?
Yeah, correct. Yeah.
So I'm like, if someone wants like a $1 million home,
right,
but they're,
so if they want $1 million home, a veteran, let's say they want $1 million home. So let's just say the house is for $1 million, and because of the debt to income ratio restrictions, the maximum loan amount is they can afford is $700,000. So we'll give them $700,000. They just need to come up with the remaining $300,000 plus the closing costs.
Oh, no matter what, they can get that max.
Sure.
Even if they're only making like 60 grand a year.
Well, as long as the debt to income ratio. Yeah.
So what's their? Oh, okay.
So it's typically about like
for that. Okay, got you.
It's typically about like 50%. In some cases, you can go up to like 55 if you have some compensating factors, like a good credit score. But that's kind of the main difference is, conventional, that's kind of the cream of the crop. You're going to get your best terms, best rates, low down payment for first time home buyers, 3%, good rates, terms, and all that. FHA, very flexible terms with the guidelines, low down payment requirement, still very attractive interest rates too, typically lower than conventional rates. But one more unique feature of FHA loans is the upfront mortgage insurance premium. Okay, so for FHA, and again, it's a flexible program, so it will help you get into a home, what I mean, and start building equity. But the upfront mortgage insurance premium, it's a fee, it's an extra cost that gets tacked onto your loan. So they charge 1.75% of whatever the loan balance is, and then they just add that to your base loan amount. Okay, so they just add that, and then that's your whole loan amount, and that's what you're paying on. And then plus you have monthly mortgage insurance as well on there. That's typically a little bit more expensive than conventional. So like we were saying earlier, there's a trade-off. If that's what your situation is, but that's what gets you into the house, then take that route and then improve your financial picture as you're in the home. And then when the opportunity comes, we can refinance you and put you in a way better loan.
So how does this mortgage insurance, this premium mortgage insurance, have to stay on for the life of the loan?
Good question. So for conventional loans, that falls off. The mortgage insurance falls off once the loan to value ratio reaches 80%. So if you bought $1 million home and the loan balance is at $799,999, then you can remove the mortgage insurance. What should people kind of pay attention to with this house? Like, why should someone buy this house? Because this is a beautiful home. It's a beautiful layout, great space. What should someone kind of look at or keep their eye out on for this particular home?
You got to look at the numbers. You got to get pre-approved first, 100%. And once you can see, because you know how much you can afford. Because a lot of people now, the number doesn't really matter. It matters about your monthly payment. How much are you paying monthly for your current bills, and versus how much you're going to be paying for your new house. Because especially if you're renting, right? Because that rent can always increase, right? Because look, once you get a new place, right, you're gonna want to rent it out, and then you're an investor, you're in business, you want to continue to increase that rent. Maybe not every year, maybe every couple of years, because inflation and everything. You have bills, a family, and everything to keep up with. So just like these landlords do. So getting your own place, get pre-approved, get your own place, get a locked-in rate. And if the rate does go down, you can refinance. But that's where we start right there, getting pre-approved. And that's where we can tell what the story is.